The Great Retirement Betrayal. Alright, let's get into this. We're talking about one of the biggest financial traps ever built for ordinary people, and how it's heading straight for a wall in countries with shrinking young populations and ballooning retiree numbers. This isn't some distant theory. The math has been screaming for decades, and ignoring it won't make the numbers kinder. Picture this. You spend 40 or 50 years handing over chunks of your paycheck to a system that promises to take care of you later. Then one day the checks stop coming, or they arrive but by half as much bread and medicine as they used to. That's the nightmare scenario we're unpacking today. How we got here, why the usual fixes fail hard, and what actually protects your life savings when the whole structure cracks. If this episode hit hard and made you rethink the system, please share with friends and family who are still paying in, subscribe for more unfiltered breakdowns, and drop a comment with your biggest takeaway or fear about retirement security. Every voice counts in pushing back. The story starts with a guy named Otto von Bismarck, the German highest trader and destroyer who kicked off the modern mandatory state pension game back in the late 1800s. He set the retirement age at 70 when most people didn't even live that long. It was never designed for today's lifespans or today's birth rates. He sold it as protection for workers, but it was always a political tool to buy loyalty and head off bigger unrest. That model spread like wildfire, turning into these pay-as-you-go machines where today's workers directly fund today's retirees. No real savings pile, just a chain letter with government stamps on it. Now the teaser. What happens when that chain breaks under the weight of too few young people paying in and too many older ones taking out? We're talking empty accounts, worthless purchasing power, elderly poverty exploding into the tens of millions in some nations, and younger generations crushed under taxes that kill any incentive to build families or businesses. Even the so-called safer funded accounts get dragged down by mass sell-offs and inflation fires. But here's the part people hate hearing. This collapse isn't inevitable if we face reality and move to genuine personal ownership instead of collective promises. Let's dive deeper into the mechanics. In pure pay-as-you-go setups, which still dominate most of Europe, Japan, and parts of Latin America, the system is mathematically doomed once fertility stays below replacement and life expectancy keeps climbing. Japan already sits at around 30% over 65, heading toward nearly 40% by the mid-century. Their old age dependency ratio is pushing toward 70%. That means for every worker supporting retirees, the burden skyrockets. Inflows dry up while outflows balloon. Governments either jack contribution rates to 30 or 40% of wages, which strangles the economy, or slash benefits by 20 to 50% or more. The counterargument you always hear is, we can just tweak it. Raise the retirement age a bit, bring in more immigrants, grow our way out. Sounds reasonable until you apply cold logic. Raising the age helps short-term but doesn't fix the core pyramid inversion. Low birth rates mean the worker base keeps shrinking generation after generation. Immigration. It helps marginally only if newcomers have higher fertility and pay more in taxes than they consume, which data shows often doesn't hold long-term, especially with chain migration and welfare access. And grow our way out assumes productivity miracles that haven't materialized in aging societies despite decades of trying. Japan's been stuck in low growth for 30 years despite massive debt and money printing. The math doesn't bend to hope. Funded defined contribution schemes look better on paper because your money goes into actual accounts invested in markets. Chile and Australia built versions of this. But even here, an aging population creates correlated risks that destroy the illusion of independence. When millions of retirees sell stocks, bonds, and homes at the same time to fund their drawdowns, prices drop. Models show equity returns can get dragged down by 0.5% to 2% annually during peak retirement waves. Younger savers accumulate less, and when their turn comes, they sell into the same weak market. It's not a true free market solution if government mandates and tax rules herd everyone into the same domestic assets. Then layer on the debt and inflation bomb. Aging societies rack up enormous deficits paying for pensions and healthcare with fewer taxpayers. Governments borrow heavily or print money. Real purchasing power evaporates. Look at historical parallels like Argentina's repeated inflation spirals or Venezuela's hyperinflation, where pensions became worth pennies while food prices exploded. In a bad scenario for a major economy, you could see 10 to 50% annual inflation turning into hyper territory where prices double every few weeks. A fixed pension that once covered rent and groceries now buys a week's worth of basics. Retirees who thought they were set face malnutrition, skipped medical care, and earlier deaths. Projections for places like Japan or parts of Europe show elderly poverty rates climbing toward 25 to 50% for vulnerable groups, single women especially. The worst case plays out like this between 2035 and 2055 in unprepared nations. Dependency ratios hit 50 to 70%. Trust funds or equivalent reserves run dry. Automatic cuts kick in at 20 to 25% initially, then deepen as political pressure mounts for more fairness. To avoid default, central banks monetize debt, sparking inflation that wipes another 50 to 90% of real value over a few years. Asset prices crash 20 to 40% from coordinated retiree liquidations. Families fracture under the weight of supporting parents while raising their own kids under crushing taxes. Youth emigration accelerates brain drain. Social unrest grows as promises made to one generation get broken on the backs of the next. This isn't exaggeration. The unfunded liabilities globally run into hundreds of trillions when properly discounted. One set of estimates puts the U.S. Social Security gap alone forcing major adjustments soon after the early 2030s. Scale that across aging Asia and Europe and you see why the system can't limp on forever. Counterarguments claiming it's sustainable with minor reforms crumble under scrutiny. Every parametric tweak, like small age increases or benefit adjustments, gets overwhelmed by the demographic tide. Automatic stabilizers sound smart until politicians override them during elections. The intergenerational theft is baked in. Early participants got windfall high returns because they paid little and collected from a growing base. Later cohorts, especially people in their 20s to 40s today in these countries, face negative or subinflation real returns after taxes and adjustments. It's not insurance. It's a mandatory transfer that violates basic property rights by treating your earnings as collective property to be redistributed. Even the idea that strong funded systems fully protect you fails logically. Markets are forward-looking. If demographics signal lower future growth and higher fiscal strain, asset valuations adjust downward preemptively. Plus, governments often raid or regulate these accounts through capital controls, forced bond purchases, or inflation taxes during crises. True protection requires breaking the monopoly entirely. Quotes from the historical record drive this home. Bismarck himself basically admitted the political game when he pushed the system, calling critics whatever he liked while building the foundation for endless state expansion. Later observers noted how these schemes create dependency that erodes personal responsibility and family structures that once handled elder care through private property and voluntary support. The path forward that actually works rejects the mandatory collective model. Shift to minimal safety nets for true poverty prevention, funded by general revenue if needed, but make the bulk of retirement individual and voluntary. Strong legal protections for private property become non-negotiable. Clear title to homes, savings, and investments that can't be clawed back retroactively. Encourage diversified portfolios with global reach to escape domestic demographic traps. Reverse mortgages and private annuities let people unlock home equity without losing ownership. Family trusts and multi-generational wealth building replace state promises. High personal savings rates of 15 to 20% become normal again, as they were before Bismarck's invention distorted incentives. Countries that move toward real free market pillars with individual ownership see better outcomes. Higher national savings, less fiscal blackmail, and preserved dignity for the elderly. Individuals protect themselves by maximizing portable assets, extending productive work voluntarily, and building skills that never retire. Diversify residency if possible. Never put all faith in one national pot. The horror of empty accounts and collapsed purchasing power doesn't have to be our future. It happens when we cling to a broken Bismarckian model that treats people as cogs in a demographic machine rather than sovereign owners of their labor and capital. The logic is ironclad. Collective promises without collective savings always fail when the population pyramid inverts. Personal property rights and free market mechanisms have sustained civilizations for centuries before these experiments began. They will outlast them too. Stay free.